Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500 bear market. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Now, we've been following this bear market, basically the entire time, and we've also been following this trend line for quite a while as well, and we've watched every subsequent rejection off the trend line. And I actually put out a tweet on Tuesday, so make sure you follow me on Twitter if you don't. But I put out a tweet after I noticed something. I happened to notice that every major local top on the S&P 500 during the bear market actually occurred on a Tuesday. Okay, so again, don't take my word for it. It's always best to verify, right, from the Cryptoverse, right? Don't trust, verify. So let's verify this. Okay, so the local top here on January 4th occurred on Tuesday, January 4th. We then had this local top on Tuesday, March 29th, right? The highest price that went during that run up. This one right here, Tuesday, August 16th. And then this one was sort of like a fake local top that occurred on a Thursday. So we should have known better, right? What happened? The high, if you look at this right here, the high on that day was 4,151 cents. The high on the actual local top was 4,196 cents. Now, it's only, about 50 cents or so higher, but technically it went higher. And as we know, being technically correct is in fact the best way to be correct. And so what we've noticed here is that there's actually 4 days, 4 local tops by the S&P 500 that all happen to occur on a Tuesday of all days, right? The Tuesday curse, right? So then I thought, well, does anyone else notice this? Is this a thing? Sure enough, it's actually a very common phenomenon in equity markets, and that is, it's actually called, I think, Turnaround Tuesday. So if you Google, stock market Turnaround Tuesday, what you'll see is that Tuesday is actually a fairly important day for equities, as oftentimes it can mark a reversal in the trend. Okay, so what you'll notice is that, and this is not just to the downside, right? What I first came across was that if the market shows weakness on a Monday, I think this is generally in a bull market. If the market shows weakness on a Monday, then oftentimes Tuesday will turn things around, right? They call it Turnaround Tuesday. But in the same way, if Monday shows if Monday shows strength, you can often see it turn back around the other way on a Tuesday, but to the downside. So Monday can often provide at least some insight into what Tuesday may bring. And I think average Tuesday returns are much more likely to be positive, and actually far outweigh those that are not based on anything. But if they're much more likely to be positive if Monday is a negative day. Okay, that's what I want to say. So if Monday is a negative day, I think history shows that Tuesday returns tend to be a bit better than they otherwise would. But the other thing to consider here is that these trends won't last forever. Okay, so we've been following this bear market for a while. And I mean, so far, it's lasted about, if you assume that if this is the low, right, it lasted about 9 months. But again, the average bear market lasts about 9 months. So far, you can say that this bear market has lasted an average amount of time if history is any indication. So then you might say, well, if it's already lasted an average amount of time, then are we done here, right? Is the bear market over? There's always a chance, right? Who am I to say that there's not a chance? But the main risk on whether the bear market is over or not is, of course, you guys know, right? It's whether we get a recession or not. Because while the average bear market might only last 9 months, that does not include a recession. Bear markets that are inclusive of a recession can last somewhere between 1 to 2 years. So we need to be we need to be aware that is the main risk that exists. And I see all sorts of debates about this. If you follow various macro analysts, it seems like for every possible outcome, someone has that opinion, right? There's a lot of people that have the opinion that we already have been in a recession and this is us coming out of it. There are people that have the opinion that a recession hasn't even been remotely priced in yet because earning estimates for 2023 remain fairly elevated. So there's a whole range of opinions out there. And of course, at the end of the day, no one really knows exactly what's going to happen. You can look at things like the inversion of the yield curve and other macro indicators, but even then, the uninversion of the yield curve could still take a long time to actually play out, right? History shows us that once the 2-year inverts to 10-year, it can take 12 to 18 months. It inverted in July, so this July will be 12 months. Late this year would be about 18 months or so, or early 2024. So this trend here has been reversed. Every major local top has been kicked back down on a Tuesday, meaning the local top was marked on a Tuesday. And I actually put this, I put a tweet out, right, on Tuesday on Twitter, on Twitter. If you make sure you follow me there, but I put a tweet out saying, look, will this Tuesday be the same thing? I don't really know. But in fact, if you actually zoom in here, what you'll notice is that a new local top, potentially, we don't fully know yet, right, until we have a bit more time to see how this plays out. It actually occurred on a Tuesday, again, because Tuesday, January 17th, the high was 4,015, 39 cents. The high today was 4,014, 16 cents. Again, technically speaking, yesterday was the local high. Now, I would be remiss if I didn't at least point out the fact that this market has been full of constant fake outs, right? Every time you think you know what's going to happen, it's like the market just ups and goes and does something completely different, right? How many times have you felt good because the market was trending in the direction that you wanted it to, whether it was up or down, and then the next day it was a complete fake out and we just went the other way, whether it was going up and then we switched to going down, or whether it was going down, we switched to going up. The market has faked us out many, many times. Also note that just because we got to the top of the trend line doesn't mean we have to always get an immediate reversal. Sometimes we sort of stay up here for a while, okay? I will remind you that eventually this trend line will break, okay? So eventually the trend line will break. We've had 4 tests of it so far that were clear rejections. And so far, I guess I should sort of draw the circle here because that was where the local top was. But so far, this has been our 5th rejection. Could we go back up and test it soon? Yeah, probably. Or could it be a few months? Really don't know, right? It all depends on, how many market participants are starting to price in a potential recession versus how many people think we avoid it. And that's where we, ultimately, I think that's where we currently stand. Now, the other thing that I think we have to talk about is the VIX, right? We talked about the Volatility Index last week, and we have to provide an update on that. Why? Because what we talked about was that the VIX has been a fairly good indicator of marking local tops and local bottoms, okay, in the S&P 500. And again, don't take my word for it. Let's go verify it first so that let's not just pretend like something is occurring just because I say it is. If you take a look at the VIX, what you'll notice, I have 2 rectangles drawn over here, right? So at, generally local highs and local lows of the VIX. Okay, so the first thing what I'll do is let me hide the S&P 500 so that we can more clearly see this. And if we were to draw a line every time the VIX bottomed, you'll notice that it tends to bottom in this 18 to 19 range, right? Somewhere maybe between 18 to 20, but it's usually 18 point something or 19 point something. In that range is where it has been going for a long time. So this is 1, right? So that's 1 time. It also bottomed over here in April and over here in December. And then potentially here, right, on Tuesday. We'll have to wait and see. Okay, it's too early to make any clear calls on that. But again, you'll find that a lot of these major lows, right, even over here in January, a lot of these major lows, what do you think they correspond to, right? What do you think they correspond to? You overlay the S&P 500, and what do you notice? These lows on the VIX tend to correspond to highs on the S&P, right? So the VIX bottomed here at around the 18 to 19 level in August. S&P topped in August. Same thing over here in December, right? The blue line, that's where the S&P 500 saw another local top. The VIX is potentially finding that local bottom again around that 18 to 19 level. You are seeing the S&P turn around once more. And if you go back throughout the rest of the year, right, you look at, you look over here in April and March, where you can kind of see it was almost like a double bottom on the VIX here. But wherever you take it, if you take it somewhere in between, it still gets somewhat close to marking the local top, right? So the idea is that somewhere in that 18 to 19 range is where the S&P is more likely to turn around than not, right? So if we're going to see a continuation of the bear market, it's around that 18 to 19 level that you see it actually turn back around. And then the only other thing I wanted to mention is that there was an exception, right? If you look early on in the bear market, the VIX actually bottomed closer to that 16 to 17 level, right? So it went just a bit lower. And then I thought, well, has that marked anything consequential, right? That 16 to 17 level. If you actually draw a trend line, you can draw this back for years, in fact, on the VIX. right? So, if you look over here, right, the VIX has been putting in these higher lows essentially off of this trend line going all the way back to like 2017. So, there's a potential outcome at some point during this bear market that we hit the lower bound on this, and it could be a very big fake out, right? Not that dissimilar from what we saw over here in January or in end of 2021 and or into 2021 and early 2022. So that's something I think that's worthwhile to watch as well. But I mean, at least for right now, we sort of saw a turnaround point at around that 18 to 17 level. We might have even wicked below 18, maybe not. 1801 or so it looks like is the lowest I believe it went, but somewhere around that level, right? 18, 19, somewhere in that ballpark is where we found the VIX at least finding a local low and the S&P potentially finding another local high. Okay, so these things are, I think, useful to follow. And in addition to these local lows, guess what, right? Local highs on the VIX tend to correspond to the bottom on the S&P 500, right? Local lows on the S&P 500. Every single one for basically the entirety of this bear market. When the VIX is finding some type of a sorry, I drew this one at the top of the S&P. When the VIX is finding some type of a high here, right? When the VIX is finding a high, the S&P is getting close to its bottom, right? When the VIX is finding some type of a high. Okay. And it's not as clean as the lows, but you will find that fairly frequently when the VIX is finding a high between like that 33 to 35, 36 range, it has this is the top, right? And then here was also a top, but it's not as great of a signal. But you'll notice that a lot of times the S&P finds some type of a bottom and turns back around the other way once the VIX gets up into that level, that 35, 36 level. So what I'm looking for is, if the VIX wants to turn back around here and head back up this way, that likely is going to mean the S&P 500 is trending down, okay? And if the S&P does a fake out here and goes back up, then I think we have to watch this lower trend line down here, which is where we've been bouncing off of for a long time. I'd like to finalize this video by actually looking at our comparing the bear market chart for the S&P 500 and really isolating, some of the prior bear markets. One of the ones we've looked at before is the financial crisis, but you can see that it's actually diverged from that one, right? We're really not following this analog anymore. And so arguably because nothing is really broken, right? I mean, the Fed's been hawkish, but you haven't really seen the collapse of the financial system like we saw back in 2008. And so you haven't really seen this like rip the Band-Aid off, bear market, or you haven't really seen this like rip the Band-Aid off meltdown like we saw back then. So it's probably more worthwhile to continue to observe this bear market until it's no longer one, in the context of other bear markets that were not really a rip the Band-Aid off meltdown, but just a slower bleed. Okay. Here's the dot-com crash. I mean, you can see the dot-com crash. I mean, it just lasted I'm sure it felt like forever. I mean, it was like almost 3 years. I don't really think this bear market's going to last 3 years, but you can really see just how long the dot-com crash was drawn out. But it might be more useful to actually look at this within the context of periods of high inflation. And I think some of the things you should look at would be things like the 1973 to 1974 bear market, which was also filled with a period of high inflation and recurring inflation. And what you'll notice is that there was sort of like a stage one of the bear market, right? So we went down. And then we kind of went sideways for a while, right? Where we kind of put in new lows, but nothing really that dramatic, right? So we went down for a while and then sideways for a while. You look at the S&P 500 and that's kind of what's happened. I mean, if you look at this, right, it went down for a while. And while technically we put in new lows, it's sort of just gone sideways, right? If we're being honest with ourselves, right? I mean, this has been a phase where the bulls and the bears haven't really been right, okay? Bear markets, as we know, make fools of both the bulls and the bears, right? They make fools of both the bulls and the bears because the bears are constantly calling for lower prices, whereas the bulls are constantly saying, oh, the bear market's over. And then you get these like crazy rallies to the upside. But the thing is most rallies that are returning like 20% in like a couple, maybe a few weeks, these are more common in bear markets than they are in bull markets. And so one might argue that a continuation of periods where you see like 3% gains in a day, 4% gains in a day, while that might seem very bullish, it might actually be confirmation that the bear market's not over. The fact that you're getting those types of days still. Because in a bull market, you don't really see that. It's more so just a slow trend up followed by pretty quick moves to the downside, right? Like a slow trend up followed by a quick move to the downside, just sort of scare everyone out. Whereas bear markets, you'll see fairly quick moves to the upside, and then the market will then just slowly bleed again for a while. Okay, so we have to remember this, that it operates like in this fashion, and it's a way for people to just slowly lose all their money, right? Like they sell at local lows, and then when the market goes back up, they want to then FOMO back in, only for the market then to just sell off once again, right? So again, if you go look at the 1973, 1974 bear market, which again was also during a period of high inflation, what you'll notice is that it lasted approximately 632 days, or 633. 633 days. Where are we now? 378, or 378, 379. Okay? So in a month from now, we'll be at 400 days. This one lasted another 230 days after that. Where would that put it? I mean, it would put it sometime, closer to the end of this year if it were to follow the 73, 74 bear market in terms of finalizing it, right? And if it's going to follow this, I think this is the way it would have to go, right? You have the first part of the bear market, which is sort of like the liquidity crisis, where the Fed's draining liquidity out of our system. We've talked about this before, right? We're all standing around a pool. We all are, we're all holding cups of water. That's our liquidity. The Fed is draining the pool, and at some point, as investors, we're like, oh, that looks like a good deal. Let's all throw in a cup of water. Let's add liquidity to the system. And maybe the water will temporarily rise, but the Fed is still draining liquidity. So, I mean, while it might go up in the short term, we're still fighting the Fed, right? You're still fighting the Fed if the Fed is still going through a period of quantitative tightening or QT, right? I mean, we had QE for a while, for like a decade. Now we're in quantitative tightening. And until they actually pivot, we shouldn't assume the conditions have changed. And furthermore, whenever a pivot does occur, history shows us it's not really a great sign, right? So this cycle has been somewhat, it's had all sorts of curveballs. One of the main curveballs, I think, is that normally the Fed raises rates into a strong economy. This time they raised rates into a weak economy because we have high inflation. So it's not even the most comparable to 2000 and 2008, because in 2000 and 2008, the Fed was raising before the S&P rolled over. So that by the time the S&P rolled over, the Fed had the luxury to cut rates. Now we don't really have that luxury. So if it's going to follow the 73 to 74 bear market, you kind of have the stage one of the bear market. Then we go sideways for a while. So it's kind of like you put the bear market on pause for a while. And then you have sort of the second stage of the bear market, which arguably, if we want to repeat, would be the recession phase, right? Like the, earnings are going down. Oh, people are unemployed. Okay, that would be that phase if it comes. Of course, there's plenty of people that are betting that phase won't come. There's plenty of people that are saying, hey, that phase will come. Let me show you another example. Because if you think that it has to follow this, I mean, let's wake up here for a minute. There's also a period of high inflation in the 40s, and look what happened then. We just scraped the lows for years. I mean, imagine how painful this would have been if you sold the bottom. Because then you just basically wait for it to come back up. Or sorry, if you sell the bottom and then it comes back up, you constantly wait for it to just go back down. It finally gets close, and then it just rallies again and doesn't come back down to the lows for another year or more. This is how brutal bear markets can be sometimes, especially during periods of high inflation. So what I think we all need to understand is that, bear markets are brutal. And again, they're brutal for bulls and bears. Just because you're a bear doesn't mean that a bear market isn't going to make you lose sleep. I mean, they do, right? They constantly cause you to question what's going on. They make you question, your overall thesis on the market constantly. I mean, imagine what these people over here in the 40s must have felt, looking at the lows and, someone selling here only to finally see it come back down, almost a year later, only for it to just go slightly lower to then just bounce back up again. And then it just keep doing it over and over and over again. And then it ended at a slightly lower low, a very slight lower low. Take it out to the next peak. And what does it look like? You look at it like this, when you look at the S&P like this on this particular bear market, it almost makes it seem like it's just irrelevant, right? Over the grand scheme of things, right? So eventually the S&P will trend higher, I think. Okay, but you sort of have to go through these bear market phases, and they make you question constantly everything. So you have to have a strategy, right? You have to have a strategy. You have to stick to it. You have to remember that the bear market could last a long time. We may go a lot lower, or maybe we only put in slightly new lows, or maybe we don't. But it can last. It can last quite a long period of time. And again, if you look at, say, like the 73, 74 bear market and overlay it to a new high, that's what it looks like, right? So it had a pretty swift move down, but once it moved down, it then moved right back up. And imagine had you sold here, right? Imagine if you'd sold here in day like 500 of the bear market. You probably would have felt pretty good for a few months. But if you didn't buy back, it would, I mean, who cares, right? Like if you sold here, you watched it go down, and then you don't buy back, the market can still leave without you, right? It always reserves the right to do that. So again, we can look at plenty of bear markets. There's all sorts of bear markets. Here's another one where you saw one last move to the downside, and then that was it. So, I mean, it really just goes to show you that every bear market is different, right? No bear market is the same. Sometimes they look similar, right? Sometimes they'll look similar. Like, again, the financial crisis, they'll look like they're very much the same until they diverge. Just like when you compare this to the 40s, they look very similar until they diverge. And the 70s, they look similar, but eventually they're going to diverge and do something different. Here's the one in the 80s, okay? Not that dissimilar. I mean, the moves aren't identical, but you can kind of see very similar. It probably would have had very similar, effects on investors, right? All these, highs followed by a lower high and a lower high and a lower high, and it just kept going on and on and on. And I have to imagine that every single lower high, just like today, right? Just like today, every single lower high, not only in that bear market, but if you go look at, say, like the .com crash, I have to imagine that every single lower high was also full of people calling for melt-ups to new highs, right? Every single one. Now, I wasn't an investor back then. I was only 18. But every single lower high, I imagine, there were calls for just melt-up rallies to new highs. It gets everyone to FOMO back in. They buy the new local top, and then it just goes right back down. Okay, so look, and I'm not saying that you should be completely out of the market. I'm not giving financial advice or anything like that. My point is that if you get into a nasty cycle of selling the bottom, right, selling the bottom and then buying the top, it's a great way to lose all your money in a bear market, right? So you have to have a strategy. You have to stick to it no matter what. That's my opinion, and then just follow it through, and then eventually. Well, maybe I shouldn't say like stick to it no matter what. I mean, you are allowed to change your opinion about things, but if you can come up with a strategy and stick with it for the long haul, history shows us that it will typically work out, even if it takes a while, right? Even if it takes a while, it will work out. What typically won't work out is if you buy every time the market is every time the market is going higher, and you sell every time it's capitulating. This doesn't really tend to work out very well. And if you take this within the context of the bear markets that we've seen, this is where we currently stand, okay? This is looking at sort of the lower bound ranges and the upper bound ranges for the bear markets that were continue to be bear markets at this phase. We're actually not as bad off, as we were back over here. Over here, we were sort of in the middle of the range. Now we're actually getting a little bit closer to the top of the range. So if this bear market wants to continue, which I imagine if it does, it'll be based on recession fears, then we would be coming into this area over here, sometime over the next several months, right? If, on the other hand, we see a fake out to the upside, then we still, or maybe it's not a fake out, right? If we have a move to the upside, it doesn't mean it's over. It means that it's time to probably really start to pay attention, because the bear market is going into a new phase while we wait to see the resolution of whether we get a recession or not. But again, I just want to sort of finalize everything by saying, look, so far, this bear market, we've seen local tops on 4 Tuesdays. This is potentially the 5th Tuesday, right? The local top occurred on Tuesday, January 17th. Does that mean we can't go higher? No, it does not. We could always pop back up And maybe we'll get rejected next Tuesday, right? I don't know. Or maybe we'll finally break through. But it does go to show you that this trend line has provided resistance several times so far. And despite all the declarations for sustained melt-ups in December and in August and in March and last January, they all eventually resolved to the downside and the bear market continued. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. Remember to have Into the Cryptoverse Premium at intothecryptoverse.com. Thank you guys for tuning in. I'll see you next time. Bye.